and Associates here, located here in Flint, Michigan. I'm Flint born, Flint raised, Flint educated. I graduated from University of Michigan, Flint, graduated from Flint Northern High School, then got my Bachelor's of Business Administration and Finance from U of M Flint, came back, went back and got my MBA in Organizational Leadership and became a licensed certified public accountant. I currently am the Chief Financial Officer for the Detroit Public Library. So I've been in the city of Flint, lived in the city of Flint, grew up here, particularly north side of Flint. I'm just down the street off of Martin Luther King and Jackson. So I'm a Flint boy.
Flintstone.
Yeah, Flintstone. So I love my city. I love the people of Flint. And so Chia Morgan and I, we sat down one day and we started discussing some of the struggles that we have during tax season. It seems like every year, same struggle happens. And how do we break those cycles? How do we take on those challenges to educate the public, to educate people who may not know? And me being a licensed professional, and her being connected with the city and having a love for the city, we decided to put this workshop on. I also want to thank Gil and Nigel. They have been, Nigel's from Prudential, and Gil is from Principal Group, and they are the ones that are providing the food tonight. So we want to thank them for being our sponsor, our food sponsor. Yeah, so I know we're live. We're live on Periscope, I believe. So if you Facebook, so if you still want to come in and be a part of the workshop, we will certainly welcome you to be a part of it. First thing I want to talk about for the 2017 filing season is what's going on, what's happening. One of the larger things that's going on is, you may know there is a delay in tax refunds this year. The particular delay is with if you receive an earned income tax credit or if you receive an additional child tax credit. What that means, and this affects, unfortunately, some of the lower income wage earners who qualify for the earned income credit. Typically, there's a sliding scale with the earned income credit. I believe the maximum is right around $4,500 for the tax year 2017, and then it kind of phases out as you earn more money. So if you claim that if you claim that tax credit, or if you claim the additional child tax credit, the additional child tax credit typically happens when you have more than one child. So you may qualify for the additional tax credit. These two tax credits are what we call refundable tax credits, meaning you get that back as applied against your income, and if you don't have any taxes and you get an earned income credit, you don't owe taxes, you have an earned income credit and additional child tax credit, you'll get those monies back. So the IRS, or Congress passed the tax law protecting Americans from tax hikes. That was the act, Protecting America from Tax Hikes of 2016. They passed it, and it's requiring and demanding and mandating that the IRS delay those refunds until February 15th. So what that means is, if you claim those taxes, your tax preparer can prepare your taxes starting, well, actually the starting date for tax filing was this past Monday, but your tax preparer can prepare those tax returns for you. However, he or she cannot submit those tax returns until February 15th, okay? So if you are claiming an earned income credit or an additional child tax credit, you cannot file or process those tax returns, even if you mail them in. You cannot process those tax returns until February 15th. And typically, we've kind of been cultured now to where a lot more Americans are choosing to directly deposit your tax return, which is really the fastest way to get your refund. It typically takes anywhere from 8 to 14 days in a given tax year to get your tax refund if you do direct deposit. The IRS has made it their point to not to delay those refunds past 21 days, unless there's something wrong with the tax return. If there's something wrong with the tax return, it could be longer than 21 days. But typically, I haven't seen too many tax returns that cleared, that were accepted by the IRS, that did not get their refunds within 21 days. So that means for those tax returns that are claiming the earned income credit and additional child tax credit, you probably will not get your tax return refund until right around the 1st of March. I think that's important for you to know, that you won't get your refund, even if you directly deposit it. You won't get your refund via direct deposit until the first part of March, March 1st, March 2nd. Okay. The second thing that we want to discuss as far as news and updates is with the new adjusted gross income requirements for e-file. And I'm reading this directly from the IRS website. You can go to the IRS, you can go to www.irs.gov and get the same information that I'm getting you. So you can go to www.irs.gov and get this information. And per the IRS publication published on January 23rd, 2017, it says all taxpayers should keep their tax return beginning in 2017. Taxpayers using the tax filing software products for the first time may need their adjusted gross income amount from their prior year tax return to verify their identity. Okay, so that means for you that are using TurboTax or any tax software system that's provided by the IRS or that's provided by a third party, this year you will have to keep your 2017 tax return because you have to verify that adjusted gross income total from your prior year. They will not accept your electronically filed tax return if you do not know what your prior adjusted gross income is. Okay, that adjusted gross income, depending on the form that you file. There's typically 3 types of forms. There's 3 types of forms that normal taxpayers file. And that's a 1040, a 1040A, and a 1040EZ. That's 1040, 1040A, and a 1040EZ. The adjusted gross income line item is at the bottom of page 1 of the 1040. And it's in the middle of 1040A and it's in the middle of 1040EZ. It says adjusted gross income. So even if you're preparing your tax return this year, you have to have your last year tax return. And I know with the advancement in tax software, it's easier for people to do their own taxes with TurboTax, and that's fine. But still, you have to know where your 2015 tax return is to access that. So just keep that in mind as well, that beginning in 2017, first time tax preparers may need their adjusted gross income to verify your prior tax return, to verify your identity. It says taxpayers can learn more about how to verify their identity and electronically sign their tax return at validating your electronically filed tax return. That's on the IRS website, www.irs.gov. There is a section that says filing. Actually, the section says 2017 tax filing season opens today. 2017 tax filing season opens today. That's the article that you want to link. Just click on that link and read down. About halfway through, it tells you that the new AGI requirements for e-filing. Okay. Yes.
So what if you wanted to allow someone to file your child for you this year?
The question says, what if I wanted as a taxpayer someone to claim my child for me? That is not correct. So, all right. So
Because I know they're changing a lot of things that you may have been able to do in previous years.
Well, I'll say this to answer your question directly. This has been a problem, and this is what the IRS is trying to crack down on. And that's the claim of dependents that you cannot rightfully claim. So that means first of all, in order to claim a dependent, okay, there's rules to claiming your dependent. First, that dependent, you have to provide at least 51% of the care for that dependent. That means you provide food, clothing, shelter for this dependent. That dependent has to be living in your household for at least 6 months, okay? And you have to verify. You have to be able to verify their location in your house, okay? That's the first requirement for dependency. Children, in order for you to qualify for the child tax credit, which is a $1,000 tax credit and refundable tax credit, they have to be under the age of 16. If they're 16 or older, they don't qualify for the child tax credit. They can qualify as a dependent, but they don't qualify for the child tax credit, okay? Depending on your income, claiming children and claiming dependents, you know, it could change your refund, it could change your tax liability. Claiming dependents will allow you to have an exemption of about $3,700 this year for 2016 filing season. So it certainly adjusts your tax liability. However, we must be cognizant of doing things by law. And if you are claiming dependents that are not yours, see, here's what the IRS has. And I'm just going to be honest with you, since we live on Facebook. Here's what the IRS and the federal government has access to. Federal government has access to your child's school records. Federal government has access to your child's school records, Social Security, etc. So the way that most people get caught by claiming kids that are not theirs is your child, that dependent's Social Security number has to go on the tax return. And what's on that tax return is a parental address. Okay, so your address and your Social Security number can be verified with the school system, Department of Education. So Department of Education says part of the verification process is we go and we see the address that's on the tax return for this dependent, and then we also see thank you for coming, we also see the child tax records that is from the school. So they can verify your existing school records. Yes.
I have a question that says, ask him if you can file separate taxes if married and not get penalized.
Okay, I will answer that question. I'll answer that question as well. But So to answer your question, don't have kids, don't claim kids that's not yours, and that you don't legally have a capability, to do. I'm telling you, because what happens is the IRS sends you a letter and it sends you adjustment saying, they take away all your tax credits and then send you a bill for $6,000. Okay, let's just say, for instance, because what's attached to that? Attached to that, it could possibly be an earned income credit, additional child tax credit, exemption. So they strip you of all that and say you owe us. And then you have to come to someone like me, a licensed CPA or a licensed enrolled agent, okay, to help you through this matter. And it all could have been avoided. It all could have been avoided because I guarantee you the IRS has more information about you than you think you know. They have more information about you than you really think they should know.
Yeah.
The long arm of the law is not just a cliche. It's only a cliche because it's true. Okay? But to answer that question, you said, what was the question again?
Can you file separate taxes if you're married and not get penalized?
Yes. There is a, well, I'll say this. The proper way to file separate, if you're married, is to file married, filing separate. That is a legitimate way of filing separate. Okay? Now, this is where it kind of gets murky. Because a lot IRS has there's some codes in there that says if people are kind of legally separated, you can file as separate. You don't have to use the married filing separate. If spouse just leaves and walk out and they're gone for 6 months and you don't know where they're at, you can file separate. That's called separation. So you can file as single or head of household. But if you live together as married couples, okay, and your filing status is as of December 31st. So if you were married as of December 31st and you live together, you can file married joint or married filing separate. Okay, so you can legally file separate. What you cannot do is if you live together, you cannot have your husband or your wife, one spouse file single and the other spouse files head of household. Can't do that. That's against the law. Okay, you cannot, if you live together throughout the year and y'all been married all year, your mail go to the same house, your children live in the same roof, and you all live together in traditional marriages, you cannot file, one person cannot file single and the other person file head of household. That's against the law, yes.
How are the anticipation refund laws affected with the changing filing dates for 2017?
Yeah, okay, so I'm glad that question, because that was a part of my discussion. So just to kind of give you a little history on these these refund anticipation loans, okay? They started back out in the 1980s. And it started when you could start to electronically file your tax return. So back in the 1980s, you had to file your return and then wait for a check. Well, it started to hinder some of the tax returns, primarily for lower income individuals, people that normally claim an earned income credit. So what happened was once the IRS allowed for electronically filing, tax professionals saw this as an opportunity to kind of prey on the lower income taxpayers. And they did this through a third-party bank. So what happens with these anticipation loans, these refund anticipation loans, is it used to be where you would file and then a third-party bank would intercept that tax refund You pay a fee, they give you a loan up to a certain amount. Let's say $1,500, you could get a loan against your refund for $1,500. They charge you this god-awful amount of interest, somewhere up to 300 to 400 to 500% interest, okay, on a refund, okay? That doesn't include the processing fee. That's just the interest. So there will be a processing fee. And on top of that, you have to still pay the tax preparation fee. Okay, so let's say you're getting $4,000 back for your refund. When you add up the interest, you add up the processing fee, you add up the tax preparation fee, you're literally paying over $1,200. So your $4,000 refund goes down to right around $2,800. And you can only get $1,500 of that up front. So when the IRS would process your tax return, you already got $1,500 up front. So you get back $1,300 once the IRS processes your tax return. So in total, you got $2,800 out of $4,000 that you could have got. Now, the IRS tried to combat that with the direct deposit. They said, okay, well, you know what? If you can just wait 2 weeks, then we'll process those tax returns to help mitigate those predatory lending practices. And in 2010 through 2012, there's been legislation passed that rejects refund anticipation loans. What these larger companies are doing, when you see you can get your refund based off estimated tax returns. What these larger companies have essentially said is for you to, you can qualify for up to $1,250 or $1,300, these loans interest-free. These loans are legitimately interest-free, but they only apply to those that qualify. What these companies are not telling you are the qualifications. Who qualify? How do you qualify? No one knows but these companies, because they're the ones that's lending you the money. One of the larger companies has taken out a $1.62 billion line of credit that they are lending to these individuals wanting these tax returns. What they don't tell you is how much your tax return is going to be, your tax return preparation fee is going to be inflated. The average tax return in 2014, the average tax return for 2014 was $273. That's how much it costs. I mean, we're talking about 1040As, 1040s, Schedule Cs, etc. Okay? The average tax return costs $270. When I've taken on clients and I've seen the costs when they left those larger companies and came to me, and I saw their prior tax return and the cost, it was astounding for something so simple. And what they do is they charge you what they call a per form charge. Mm-hmm. So they charge you per form. So they charge you for the 1040, then they charge you for the EIC form, then they charge you for the additional child tax credit form, then they charge you for processing the e-file. Then if you add up all those costs, yeah, for the 1040, it's only $125, but you've got another 4 or 5 different forms, right, that you have to file in order to properly file that 1040, and yes, the cost gets astronomical comparatively. So right now, what's being given to us as, or presented through these commercials as refund loans, or what they call tax return anticipation loans, they are legitimately interest-free, but they are going to recover those costs through inflated tax return preparation fees. Here's one other thing I want you all to consider as well. When we talk about getting refunds based off of your tax returns, it used to be that the tax preparers had access to any debts or levies that you may have against the IRS. So one of the things that they would do in order for you to qualify, they would ask you for your social security number, date of birth, and they would verify with the IRS if you had any liens against your tax return. That was one of the qualifying tax for accepting whether or not you had a refund. Well, in 2012, the IRS did away with allowing tax preparers to access the IRS to see whether or not you had levies against your tax return. So, for instance, you're getting a tax return for $4,000, okay? But in 2013, you went to school, all right? You took out student loans, okay? 2013, you went to school, you took out student loans. In 2014, you stopped going. And Sally Mae didn't forget that you went to school. You have not paid your tax return or your student loans in 2.5 years. Sally Mae did not forget that you owed her. So what Sally Mae did was put a lien or levy against your tax return. So Sally Mae knows, remember I told you how the government works? They're in cahoots with, they have access to all your information. So Sally Mae talks to the federal government, says, yes, brother does not have his stuff together. Matter of fact, we put his student loans in student loan deferment. Okay? Not forbearance, deferment. That means you have deferred to pay. So you owe the federal government for going to school back in 2013. Well, you have a tax levy. So you get a $4,000 tax refund. Sally Mae says, give me that back. Because you owe us $8,000. Okay? So they put a levy against your tax return. You go to one of these larger companies and you take out a refund anticipation loan or a tax refund loan against your refund. They prepare your tax return. They say you're going to get $4,000. Here's $1,500 up front or $1,300 up front, okay? And we will get our money on the back end. While you're waiting, they get a notice. And they say, yeah, about that $4,000, IRS is going to take that. IRS took it. So not only do you owe that $1,300 back, but you also owe the $300 or $400 for that tax preparation fee. So you owe the $300 plus the $400 tax preparation fee. You owe $1,700 plus you owe Sally Mae another $4,000 because you owe her $8,000 before. Now your debt is $5,700 because you neglected to handle, the business. I'm not talking against you when I say this, but I want you to be aware that this happens. This happens. I see at least 2 or 3 clients of mine every year that has this problem. They didn't check with the IRS. They didn't handle it. And now they're in deferment, and they didn't know about it until until they got a letter from the IRS saying there was a levy against your tax refund. There was a question of yes.
Yeah, can you just shed some light too on an injured spouse? Like, why would a person file injured spouse? Just if they're married and they're filing jointly, why would they file, injured spouse?
Yeah, that's a good question. The question was in relation to injured spouse and why file injured spouse. And that's a good question. Filing injured spouse allows relief for the spouse who does not have a tax levy against them. So you have a married couple, they are filing joint, but one person has a levy against their taxes, and the levy could be for anything. It could be for back taxes, it could be for child support, it could be for student loans. Doesn't matter, whatever the levy is. One spouse has it, the other one doesn't. The IRS allows a special filing called injured spouse. You still file married filing joint. But the injured spouse, what happens is we separate the incomes. So one spouse has their income, the other spouse has his or her income, and any refund that applies to the spouse that does not owe or does not have the levy, they get their refund. The spouse that owes, who may have a refund, the IRS levies that refund to pay that debt. That's injured spouse. Did I answer? Did that make sense? Okay. Yes.
If you have a tax levy and you find out, say, December 22nd, and you make a payment by the 23rd, does that prevent your taxes from being levied?
No.
Okay.
And I say that kind of roughly. I'll say this. It depends. Now, if you make the payment,
just a payment towards it.
Now, if you pay on it, no. But if you pay the penalty or the amount owed and you have a levy against you, then the IRS will not levy you. But if you owe, if your taxes or your student loans are in deferment by the U.S. Department of Education, okay, you have to go through that process. Now, there's special circumstances for each individual. Sometimes people may qualify for a 12-month program where they have to make certain payment. They have to make a certain payment amount over a 12-month period in order for your student loans to be out of deferment. Okay. At every point, you can ask the IRS to set up an installment agreement. You can't enter into an installment agreement with the IRS to pay your taxes. However, if you owe the IRS, even though you have a installment agreement in place, if there is a refund this year in your tax return, the IRS will apply that refund against your existing tax debt. Okay, so a payment plan does not get you out of not paying the IRS. You're going to pay the IRS, yes.
So I hear that everybody is saying it's better things to do with your taxes than go and spend them at the sales. When you go to the bank, you don't get a good interest on your money. What are some ways that I can make money off of my tax money?
Okay, that's an excellent question. Beautiful question, and this is why we're here, right? I can tell you about the plights of tax return and everything, but this is part of this discussion is about using your tax credit to go to a different tax bracket. Okay, the IRS has special laws and special considerations, and we have with us Nigel and Gil. Both of which are trusted financial advisors in insurance and financial planners and investment professionals. But one of the things that you can do with your tax return, for sure, is to set up an IRA. Okay, that is a individual retirement account. Okay, you can actually use your tax refund to go to a financial advisor and set up your own individual retirement account. Okay, that is a wise investment. That's going to the IRS allows you to contribute up to $5,000 a year into your own individual retirement account. Okay, that is a tremendous way to allow your money to grow for you. Because remember what a tax refund is. Okay, understand what a tax refund is. The United States has what we call a progressive tax program. It's progressive. That means as you earn money, you pay your taxes, and as you earn more money, you may pay more taxes. The highest tax bracket is like 38% right now. Okay, so up to 38%. But for so what happens is we pay our taxes. For most people that work, you pay your taxes through deductions, withholdings, income tax withholdings, right? So you get your gross amount, and then you get the net amount. And net amount is, you almost have to cry, because most of it is taken out for taxes and insurance and other things. So what the IRS says is, over the last year, as you've been paying your taxes, you settle up with your tax return. So you prepare your tax return, you may qualify for certain credits, etc. And then at the end, they may say you owe, or you overpaid your taxes. Essentially, that is like a 1-year interest-free loan that you gave to the government, because you didn't owe those taxes. You actually settled up and you paid them. But because of our tax laws, you pay those as you go. Okay, so the IRS gives you your money back, a certain percentage of your money back. Now, some people don't have any tax liability once you settle up. So you get all the taxes, all the income taxes that you paid, you get that back, plus any credits. All right? So that's what happens. So you've already paid this money. Okay? IRS has held it for you. So why don't you take the money that you already paid and invest in yourself, right? It is alarming to me. It is alarming that over 80% of inner city urban adults, 80% of them do not have life insurance. Do not have life insurance. Okay? What if there was a way that we could work a plan to where you got X amount of numbers of life insurance? I'm not talking pennies. I'm talking hundreds of thousands of dollars worth of life insurance. Because the greatest distribution of wealth happens at the point of death. That's been historical since man existed. The greatest distribution of wealth happens at the point of death. So instead of asking people to help you bury someone, why don't we think strategically, buy a life insurance policy? It could be whole life, it could be term life. I'll let Nigel tell you what your options are. But what if we could do that for you and you already paid this money? You could get $200,000 worth of life insurance for $800 a year. Take $800 and pay your life insurance out right now for a year, using your tax refund. Now that helps your net worth, and it helps your family at the point that, because one thing I know, one thing is absolute, you're going to die. At some point, it may not be for 40 or 50 years, but you're going to die. And that's going to happen. I don't know anyone that has been alive. I don't know anyone personally, okay? When I say personally, I mean personally, that has died, okay, and is still walking the earth after they die. I don't know anyone like that. So, you're going to die. And you're going to have expenses when you die. And you're going to probably, if you went to school, you may possibly have liabilities. If you own a home, you may have a mortgage. I mean, there's a lot of things that happens after death that the ones that are left behind have to deal with. Why not deal with that now? Using your money that you already paid. You already paid for your life insurance. The IRS just held it for you. Yes.
If someone wanted to have their taxes prepared by you, you said that you are the chief financial officer at the Detroit Public Library. How are they able to get with you? What are your hours of availability?
Yeah. So if you want to schedule an appointment, you can do that through my website. My website is www.ac as in cat, Brown, BROWN, CPA, C as in cat, P as in Paul, A as in apple.com. www.acbrowncpa.com. There's a contact form on my website, fill out the contact information, and we will get back with you on that, yes.
Last question. Some of these are being text, some of them are on Facebook Live. Are you available, are you taking new clients as a financial advisor at this time for someone who wanted to redo their budget?
Okay, so I'll tell you what I'm licensed to do. Because I'm not licensed to financially advise you. However, I have a partner who is licensed to provide some services. This is what we're talking about. We're talking. See, we playing checkers, and society is playing chess. I'm just gonna be honest with you. Okay, we don't collaborate as well as we should. Okay, so I don't need to have all of the skills. I need to have resources that I can direct you to. So I'm going to ask Nigel, since the question has arisen, I think this is a good transition to allow my friend Nigel to come up and to address you all. He is from Prudential Life Insurance. He is a licensed professional. He's from Southfield, Michigan. I'm gonna ask Nigel to come up and greet the people at Facebook and greet the people at live and then answer some questions. I will be back.
They got one question.
Okay.
It was already here. I didn't see it.
Okay.
What is OASDI versus federal?
Say that again.
OASDI versus federal.
Oh, okay, yeah, that's Social Security. That's Social Security tax. That's different from your federal income taxes. Okay, so you're paying part of the great deal. All right, the New Deal. Yes, excuse me. Thank you. Part of the New Deal was the invention of the Social Security Administration. Social Security. So after you retire, you pay so much in Social Security. You retire, you get Social Security back. All right. So that whatever the acronym is Social Security and FICA taxes. So we are paying for the retirees that are retired right now, and I won't get into the political intricacies of that.
Okay.
Okay. At this point, I'm going to ask Nigel to come in and address you all, and then I'll be back after Nigel.
So let's expect it. Be on live.
You want to come off live? You want to just give them your contact
No,
information?
keep them on live. Talk to the people. The people want to know.
Okay.
Talk about insurance
And let them know like how they can prepay, because he kind of touched on prepaying their life insurance for a year, or how they can handle those
Yeah,
payments.
there's various ways to do life insurance. Like clearly, most people are stated. But one of the main things that he touched on is like the transference of wealth, and 75 million American families rely on life insurance products, and that's just the way it is. That's how a lot of people, like a lot of these rich families and things of that nature, that's how they became rich. Somebody died, and then the person that died had life insurance, so they passed it on to their heirs. So that's one thing that a lot of people need to do. And also, I mean, life insurance has various things that you can do with it. Some people use it as another way to fund their retirement. Some people use it to fund, like, covering their mortgages and things of that nature. And clearly, just the main thing was to cover funeral costs. So, I mean, I'm pretty sure all of us at some point has seen a GoFundMe account or family members passing a bucket or things of that nature, trying to collect funds so that they can have a proper burial for that family member or friend. So this is like one of the things that we need to try to do a better job of, is getting prepared so that when something does happen to us, our family doesn't have to bear the burden of that. You can go ahead.
So it's best to get life insurance while you're young, because the older you get, the more it's gonna cost, and the harder it's gonna be to obtain that insurance, correct?
Yes, life insurance goes on 3 things: age, health, and gender. Females pay less because they typically live longer. The older you are, then the closer you are to your life expectancy. And then if you have health issues, then they may try to prorate you that price so they can make sure they get their money worth out of it. Yes.
Can you take out a life insurance policy on a loved one? Like if I wanted to take out one on my sister or my brother, my mom, my dad, is that legal?
Yes, you can, but that person would have to be knowledgeable that this is going on. They would have to sign off on it too. You can't just take a policy out on them and they not know it. Because, I mean, a lot of people may be up to no good, so make sure that you're not gonna take out a policy on them, they don't know about it, and then mysterious accident happens, so. yes.
Okay. And with your taxes, when you get your taxes, you get $4,000 back. Is there a limit to how much you can spend on life insurance at one time? Like me, my sister, my mom, my dad, my daughter?
No, there's not.
Okay. So I could put all of my tax return towards a life insurance policy.
Yes, you could.
Can you pay multiple years at one time?
I mean, you could, I guess.
Okay.
Because there are various types of life insurance policies that have like flexible premiums, things of that nature. So as long as the money is in the account for them to take out the expenses for it, then you'll be fine.
Okay.
She's not trying to take your policy out on you. I mean, you guys talk about that afterwards. Yes.
My question is going back to what you had stated. When I was in high school, this must have been 11th grade for me, we had a teacher tell us that we didn't need to worry about health insurance if you don't have children. You don't have anyone that you have to take care of, then you don't, that's what he was basically trying to tell us. And therefore, why have an extra bill? And that's what his whole thing was basically telling our class.
So if you don't have, do you have other family members that will have to bury you, or if something were to happen to you?
Yes, that's why I didn't understand what he was saying, because I'm like, well,
So,
either way.
I mean, he may say that you might need as much to make, I mean, if you're not trying to leave a legacy to the kids, then you might not have to take out as big of a policy, but you still would need to make sure that your loved ones don't have to struggle to make sure your final arrangements are taken care of. So, I mean,
Or if you're getting cremated, you don't even, so the price is really.
Exactly. So it just depends on what, like, however you want your final request to be, and how you want your family to take that on, and or if you want to leave anything extra to your family outside of just covering final expenses. So just varying factors.
Okay, thank you.
So you're welcome.
Does anybody else have questions for Nigel on live?
Specific? Thank you.
So how can we get in touch with you?
Yeah, how can we get in touch with you?
Yes.
Okay, my office phone number is 248-688-3651. Again, that's 248-688-3651. Or if you'd like to do email, it's nigel.walker@prudential. That's nigel.walker@prudential.com.
All right, thank you very much.
Thank you.
Thank you, Nigel. You did well on live. You know.
Everybody eating, they too busy to even clap for them. They all full.
Yeah, and like I said, I mean, this is a part of wealth building. Okay, this is a wealth building exercise. You know, I just know that we as a society can do a lot better, and especially me being from Flint.